I get asked, Karlton, how do rich people avoid taxes legally? Obviously, they're not in jail, so they're doing something that other people aren't doing. And really, it just comes down to 3 techniques. And I want to give you those 3 techniques. And after you understand this, you can start to formulate whether or not this is possible for you. At the end of the day, this information is in the tax code, which means those who leverage the tax code have the ability to unlock some of these savings that I'm about to show you. So let's jump in. First thing I need you to understand is rich people utilize a technique called income shifting strategies. Now, some of you guys have been on my YouTube channel for quite some time. You've heard of me talk about income shifting strategies. You just didn't know that it was an income shifting strategy. But placing your children on payroll is an income shifting strategy. Sure, it's only a $14,000, maybe $600 deduction per child, but that starts to add up. Now, some other income shifting strategies include the 401k, the cash balance plan, and the defined benefit plan. Although these are retirement accounts, you're able to park a lot more money into a cash balance plan or defined benefit plan as opposed to having a traditional 401k or a SEP IRA. So income shifting strategies is always going to be number 1 for wealthy and rich people. They're going to shift income off of their tax returns so Uncle Sam can't get that income when it comes to taxation. Now, many of you guys are probably aware of this. The second and probably one of the biggest ways that rich people avoid taxes is through depreciation. But depreciation is a tool that the wealthy are receiving from buying the right type of real estate. Anytime that you buy real estate, you're given depreciation for the wear and tear of your residential or commercial property. The IRS will allow for you to perform strategies to accelerate depreciation on your tax return that can create what's called a paper loss. You have a paper loss on your return. The paper loss could, if you do things the right way, offset your W-2 income or offset your 1099 income. Many taxpayers are learning about the short-term rentals or qualifying their spouses or themselves as real estate professionals, and they're able to use depreciation to create a big enough paper loss that offsets their S-corporation income, their W-2 income, their LLC income, or even their investment income. I am always going to use depreciation on my tax returns. It's how me and my wife have been able to avoid taxes for many years, and we probably are going to continue to buy more real estate that makes sense, that's going to give us enough depreciation to remain in this tax-free state. But last but not least, and one that probably many don't take into consideration, is tax credits. Yes, wealthy people are investing for tax credits, and they're investing in things that most traditional taxpayers are not investing in, which includes oil and gas, and which includes solar. When you invest in oil and gas, you are going to receive tax credits and depreciation deductions depending on what type of oil and gas investment that you're getting into. I would highly encourage that any of my followers go and watch my videos on oil and gas investments and really study the working interest part of investing in oil and gas. This can turn around and give you massive tax savings that you can receive in the same year that you make the investment. But outside of just oil and gas, you have solar. And solar can provide you a 30% tax credit relative to the amount of money that you're spending. If you're somebody that has thought about adding solar to your primary residence or to an investment property, you can receive a tax credit by switching to solar energy. But those are some of the tax credits you might be familiar with. How about film credits? Did you know that as a business owner, you can invest in the film? What if you're not a business owner? You can also invest in a film. By investing in a film, you can receive a film tax credit. And sometimes these tax credit ends up giving you a multiple relative to the amount of money that you invested. I had a client last year invest $100,000 into a film, and he received a $400,000 deduction after the film tax law was applied to his tax returns for 2023. You're somebody that's listening to this right now. You might be thinking, I would want to get into a film or invest into future films that could be coming out. Why not do this for tax purposes as well? And that's how the IRS has set up the tax code to be able to benefit you when you decide to make certain types of investments that the government cannot make. Now, outside of the film credit, you might have heard of the employee retention tax credit. This was a big tax credit that came around right after COVID, and it was really created to help business owners be able to be compensated for keeping on their employees through the hard times. You were given a tax credit of up to $26,000 per eligible employee. Guys, we saw millions and millions of business owners apply for this employee retention tax credit, receive millions and millions of tax-free income in a refund check from the IRS that they were able to apply to taxes for that particular year. And these are just some of the ways that rich people are able to shift income off of their tax returns, use depreciation, and apply for tax credits to be able to reduce their overall taxable income. And these are the same strategies that you have at your disposal within the tax code. If you need help leveraging any of these strategies that I talked about today, or you would like to just learn more, you can join our community by clicking on the link below or schedule a complimentary consultation. My team would be more than happy to see how we can best serve you in the tax planning space. Thank you so much for watching this video. I hope that you got one step closer to tax-free wealth, and you know what to do. Like, comment, subscribe, and I'll see you on the next one. Cheers.